Very warm welcome to Barry Norris. Over to you, Barry.
Thank you, Joe, and hopefully everyone can hear me. Thank you for your interest in the fund, everyone, and thanks to Acorn for organising the call. So I'm going to do 30 minutes of presentation, leaving 30 minutes for Q&A. The aim is to introduce you to the strategy, to demonstrate how the fund can help you diversify your overall portfolios through a differentiated return strategy, and certainly a return strategy which is non-correlated to both stock and bond markets. So a brief introductory to myself and to Argonaut. I began running money 20 years ago and long short in 2009. So this period includes two very distinct stock market cycles, the 2000 to 2008 market, which was led by value stocks and commodities, and the 2009 to the current day, which has been led by long duration assets, both growth stocks and bonds. So there are some people that think that the current long duration bull market is going to go on forever. I'm not one of those people. I think the debate is when it will end and what will replace it. And we think there's now a high probability that we're moving into a new cycle. So if we're right, any sort of positive return will be more difficult to come by, and will be generating positive returns at a time where most other assets are going to struggle. If I'm wrong, which is always a possibility, then we'll be in the same market as we are currently, and which we've seen in recent years, but you will sleep better at night knowing that you have me as an investment insurance policy. So what is the Argonaut absolute return? Well, the aim of the fund is to deliver double-digit uncorrelated annualized returns. And the key bit of that is uncorrelated. So it doesn't say low volatility. And, you know, it's certainly our view that low volatility, if you want that, you could just replicate it by sticking 50% of your portfolio in cash and 50% in the market. And that doesn't diversify anyone, because actually your returns, although still half of the upside and half of the downside, still come at the same time as all risk assets. So we're strongly of the opinion that the low volatility by itself is not necessarily a desirable outcome, and that alternative investments like long short should be uncorrelated. So low correlation is much more valuable when you're constructing a portfolio than low volatility. And of course, we are assuming that we're not the only asset in somebody's portfolio, i.e. You look at the volatility of the overall portfolio, and because we're one part of that portfolio which is uncorrelated, we actually improve the overall Sharpe ratio of the underlying portfolio precisely because we are uncorrelated. We've got a demonstrable track record of stock picking in both long and short books. So we're going to show you the long-term record in terms of the performance. And then finally, you know, I think we have a valuable return profile, which is difficult to replicate. So, you know, this is not a return profile which a passive can ever replicate. And it's not a return profile which, you know, a 60-40 portfolio could replicate, or a bond fund, or a long only fund can replicate. So it's certainly our view that the future of active management is not just trying to outperform a market of a long only fund, but in fact generating a totally different return profile through double alpha, which is alpha on the long and the short book. So let's come on to what do we mean by double alpha. Well, double alpha could be measured by looking at the market return, and essentially how much did your long book outperform the market by, and how much did your short book underperform the market by, and taking those together is your double alpha. So for example, in a bull market, you might still lose money on your short book, but your portfolio may well have significantly still underperformed the market. So it's important to sort of think that in a bull market, a short book will be overall a handbrake on return, but when market conditions change, it will really come into its own. And without a short book, you wouldn't have the uncorrelated return. So you can see here since 2009, our overall returns, which is the dot in the presentation here, and since 2003, our long only returns as well. If we were to look at our best and worst months and the market's best and worst months, you can see that our returns are entirely uncorrelated. And I put this slide in not to demonstrate that we only make money in good markets, or we only make money in bad markets, but to show actually uncorrelated actually does mean uncorrelated. So in the best 10 months for the fund, we've delivered 80%, the market's delivered only 4%. In the worst 10 months for the fund, the market is actually up 10% and we're down 66%. In the best 10 market months, the market's up 80%, the fund's up 3%. And in the worst 10 market months, the market is down 74% and the fund is up 7%. So, we will have our successes and we will have our failures, but the important thing is that those will come at different times than the market and therefore other funds that you own. This means if we look at our returns in negative months, since the fund launched, there's been 57 negative months. We've delivered positive returns in 30 of them. Overall, we've made 22% in those negative months, and the market is down 81% in those negative months. So let's move on to investment outlook, which is, I think, the investment outlook, I think, is the reason for this call in terms of, perhaps the timing of the value of uncorrelated returns. And you can read our investment views on our blog, Argonautica, which is available on the internet. I put in here links to the last 3 blogs if you want to follow up on these views in any great detail. So just 3 slides here, just summing up what our macro views are at the moment. So sorry sold out is something we're hearing from more and more businesses at the moment. And when you're sold out and you can't deliver product to fulfill demand, that is my definition of stagflation, because the fact that you can't make that sale is obviously inhibiting economic growth, and you can't make that sale because there are shortages. So people get very hung up on what your technical definition of stagflation is, but mine is when you're sold out and you can't fulfill demand. So COVID, the crisis, saw unprecedented monetary and fiscal stimulus. I'm sure you've all seen the graphs showing the size of the Fed balance sheet, the size of all central bank balance sheets now relative to GDP, and the fact that unlike post the financial crisis, that's also been accompanied by fiscal stimulus as well. So you've had this double stimulus. You've had, as for example, as much QE in the last 18 months from the Federal Reserve as you had in the whole of the decade following the financial crisis. So frankly, if you don't get inflation from all of this stimulus, you'll never get inflation, because there is simply no way that you could do all that stimulus without it being ultimately inflationary. I think we know that we've got inflation at the moment, but obviously the debate is whether it is transitory or whether, in fact, we're in a longer inflationary cycle. The economic recovery we've seen has witnessed a series of what have been supply shocks which have caught people by surprise. These started in semiconductors, moved to shipping. I think you can basically see shortages in most old economy industries. There's housing shortages pretty much everywhere. There's worker shortages. And I think energy is just the latest in a long series of these shortages. There are those that dismiss these shortages as just an inventory restock, so it's a recovery from COVID. I think that ignores the fact that many of these supply shocks have longer term structural drivers. So, for example, decarbonisation. If you get rid of fossil fuels, it seems pretty obvious to me that the price of all energy will rise, that the cost curve will rise, because fossil fuels, there's a reason why we've been using them, because they're generally pretty cheap and pretty reliable when we want to use them as well. If we're moving into a new era, then it's inevitable that the price of all energy will rise, including the price of oil, even if we're using less, simply because oil majors aren't looking for oil anymore. There's also what's going on in China, which we'll come on to. Basically, for the last 25 years, 30 years, China has exported deflation to the rest of the world because it's manufactured everything that the West hasn't wanted to manufacture. Now, China is moving to self-sufficiency, so it's no longer exporting, for example, a lot of energy-intensive products to the rest of the world. And that has major implications for inflation in the West, where you'll see the price of basic materials rise on a sustainable basis, but you'll also see companies and countries building their own supply chains and not relying on China. So you have, if you like, China integrated itself into Western supply chains, and now we're facing the complete opposite, where China has its own supply chain and the West has got to rebuild everything that China was doing for it. And that obviously, a lot of that comes down to security of supply. Then there are anti-globalization politics, which is, if you like, what I call the rejection of Davos man, the fact that populations as a whole are beginning to believe that globalization didn't really do much for them. That's obviously manifested itself in Brexit and Trump, but I don't think that's going to necessarily go away. And then you've had, if you like, what we're seeing at the moment is the revenge of the old economy. You've had this massive bull market in tech and innovation, and whilst long term, I think obviously that's a great thing to invest in. There have always been bear markets in innovation and tech as well, when too much capital has been allocated to this particular part of the economy. It becomes too competitive, and in fact, pricing power switches to the old economy simply because nobody's invested in it in the last 10 years. And I think that is what is happening at the moment, and why you're seeing all these supply shortages in many basic industries where we've dismissed them as simply commodity industries with no pricing power. And then finally, central banks generally believe that all supply-led inflation is transitory. They believe that market forces will come in and result in supernormal profits in commodity industries being eroded. So hence the fact that they are not moving at the moment to kill this cycle. They are behind the curve. I think the Federal Reserve has told you already that, you know, it's going to have a very slow process of tightening. And, you know, I think that that will only exacerbate longer term inflation. And in any case, you know, central banks are unable to if you like, whilst they can slow down demand, they can't improve supply. So they're unable to solve these problems in any case. So I think, you know, with the debate about inflation at the moment, there's probably three views. One is the people that think it's transitory and are going to go away. The second one is that it's not transitory, but central banks are going to kill the cycle through tightening. And our view is really different from both of those, in that inflation isn't transitory and central banks aren't going to kill the cycle. Hence why you're going to get a longer duration drip cycle when, you know, we slowly realize that inflation isn't transitory and it's here to stay. And I think, you know, maybe 6 months ago, pretty much everybody thought inflation was transitory. And now we're sort of laughing at transitory and beginning to be a bit more skeptical. Just talking about what's going on in China at the moment. China is obviously key to commodities. In the 2000 and 2008 bull market, you wanted to be long every commodity that China imported. Now I think you want to be long every basic resource that China exports, because it's no longer wanting to export that. So China has an energy crisis. There's two reasons for that energy crisis. One is it doesn't have a lot of indigenous oil and gas, and it doesn't want to be reliant on importing that. So it wants to be self-sufficient. What China has is a lot of coal, and that coal is obviously pretty cheap. But that leads us to the second problem, in that China is the world's biggest polluter because it burns the most coal. So China uses 55% of the world's coal, and it produces 30% of the world's CO2. So hence why China is also growing very fast in renewables, not necessarily because they're worried about climate change, but because if they build a wind farm or a solar farm, then it's Chinese power, not power that they've had to import from elsewhere. So China have also realized that it doesn't make any sense for China to export energy intensive products to the rest of the world. So for the last 20 years, China's dominated the aluminium market, the steel market, the fertilizer market, the cement market, all of the products which need a lot of energy to manufacture. China's been the world leader, and it's undercut all of the Western producers. If China stops exporting because it's realized it makes no sense to export energy, it's not Russia or Saudi Arabia, then Western producers of those energy intensive products are going to have a massive windfall. So let's just sort of sum up what's happened over the last 40 years with our Davos man, and what happened in the 1970s that we might be going back to. So throughout the 40 years of Davos man, you had globalization. When we had a downturn, it was typically a demand shock, which central banks could come to the rescue through cutting rates. There was a trend of outsourcing to China, just-in-time supply. You had the central banks would always come to the rescue of markets when there was a problem, because they would just cut interest rates. It was a time when asset prices went up, but wages didn't really go up. You had a long duration bull market in bonds and equities. Valuation became much less important, certainly in the last few years, in terms of analyzing stocks. Successful stock picking became about what a company could look like in 10 or 20 years. And it almost was a disadvantage that a company had sales currently, because it meant that its total addressable market in terms of growth was lower if you already had sales. That reminds me of when equity analysts aren't interested in valuations. That is very reminiscent of the end of the 90s and the fact that it's a market that can't really go on forever. But we've had a market where ROE has generally been rising, discount rate has been falling, and of course that's very good for stocks. We contrast that to the 1970s. You had supply side shocks, not demand. You had two OPEC crises in 73 and 79. Therefore, it became about security of supply. You had rising wages but falling wealth. So wages went up, but asset prices went down. And you had a commodity bull market, but an equity and bond bear market, because you had falling ROE and rising discount rates. So the point that I'd made in a recent blog is financial markets today face the risk of drowning in a bubble bath of stagflation. This isn't the typical image of falling off a skyscraper that you see in a demand shock. It isn't a deflationary bust. It's stagflation, which is drip, drip. And that means that wealth in the form of asset prices rather than wages are potentially the financial patsy. So after more than a decade of boom in long duration equities and bonds, the real risk for investors now, given that they're naturally overweight long duration equities and bonds, is that they've got no hedge for the 1970s redux. And that's where I think this strategy could fit in now, because we're certainly hedged against a return to the 1970s. And I think the difference is, when you worried about a downturn before, it was a demand shock. And in a demand shock, to hedge, you can buy long duration government bonds and you can buy defensive growth stocks. So if you're in a demand shock, those are defensive assets which will hedge you. If you're in a supply shock, like in the 1970s, long duration government bonds and long duration defensive growth stocks are the last thing you want to buy. So I think this is the key thing, in that if you're bearish, the normal things that you would look for to hedge are probably not going to hedge you. And I think that that is really the key debate for me at the moment. So let's look at some stock examples. I'm conscious that I've already talked for nearly half an hour, so I'm going to go through these quite quickly to leave time for questions. I've got some long ideas here, which are, if you like, for me, they're just demonstrating just how cheap some of the stocks are that are benefiting from these supply side shortages. And obviously the skepticism around that cheapness is based around the fact that people don't think that current prices are sustainable. So if we look at Gazprom, for example, I look at Russia as one of the real winners, both from decarbonisation and from stagflation, because whereas Western oil companies are not looking for oil anymore, the Russians have got all the oil, or a lot of the oil and gas, and they're producing it very cheaply, and they're not going to stop drilling for oil and gas. So if we look at Gazprom at the moment, on spot gas prices, which are obviously very high, Gazprom is probably on a P of about 1.5, with a dividend yield of over 30%. So let's assume that spot gas prices halve, and let's just use next year's gas price on the forward curve. So even on the forward curve for natural gas, Gazprom is on a P of 2 with a 25% dividend yield. And I think what I like about the Russian market in particular is not only is it cheap and it's getting these earnings upgrades, but the payout ratios in terms of dividends are typically 50%. So you are actually getting shareholders in Russian stocks rewarded, Western shareholders rewarded through really generous dividends. so that suggests to me I can give them a, if you like, a lower discount for being Russian than otherwise might have been the case. EDF is the world's biggest power generator, and it's mostly nuclear and hydro. And I think that's important because obviously the power price is a function not only of the energy price, but of the carbon price. And if you generate CO2-free power through nuclear or hydro, you get a sort of double whammy benefit for the price going up. So if you own a hydro dam or a nuclear plant, you're just going to have to sit there over the next 30 years and make a lot of money because of decarbonisation, because the power price and the carbon price is just going to go up and up and up. And EDF, if you think that its current contractual price this year will be about 45 euros, so it doesn't sell at the spot market, it has contracts which it renegotiates, and the spot price is 114 at the moment. So even on 45 euro power, it's on a single digit PE and a 6% dividend yield, with obviously the scope to reprice that book higher. CF Industries is the world's biggest producer of nitrogen fertilizer. As we know, the Chinese have stopped exporting nitrogen fertilizer because they need it for their own food and they don't want to export manufactured energy anymore. So this is a boom for Western nitrogen fertilizer manufacturers, particularly if you're based in the US, where gas is $3 rather than $20 as it is in Europe. And gas is obviously the main input into this. So we're seeing some ridiculous valuations. So CF's on a 30% free cash flow yield. But, nitrogen is not just about food nowadays, because nitrogen through ammonia is actually the biggest input into hydrogen production. So if you believe that ultimately cars are going to run on hydrogen, you're going to need much more nitrogen fertilizer for that, because that's the key input into hydrogen. And producing hydrogen without emitting carbon, what they call basically blue or green ammonia, is actually a big growth opportunity for the likes of CF Industries as well. And finally, Kazatomprom, which is the world's leading producer or miner of low-cost uranium. So its cost of mining for uranium around about $10. That compares to $40 or $45, which is the current price. Most other uranium producers at the moment are loss-making. So the price needs to rise quite a lot for production to increase. The uranium market at the moment is currently seeing a big deficit, i.e. we use more than we produce. And the price in 2008 at the last peak was 140. So this is a great way to play, if you like, the renaissance of nuclear power in the world. Short ideas. I categorize our shorts in really three categories: frauds, and then, if you like, fads, which are where demand is unsustainable, and fades, where supply or the economic moat is unsustainable. And we've got examples here of all of those. TPIC was at the start of this week our biggest short. It manufactures blades for wind turbines. It's not our biggest short anymore because it's fallen by 25%. It had a massive profit warning, and actually it surprised the market by actually the profit warning was so bad that it was in fact breaching its debt covenants. The reasons for that is that it's seeing its costs rise in terms of steel, resin, shipping costs, and it really can't pass any of those on, and it can't deliver its blades on time. And as a result of this profit warning, it just took a bailout of preferred shares from the respected US hedge fund Oaktree. But the problem is Oaktree haven't bought common equity, they've bought preferred equity yielding 11% per annum forever, plus free warrants, which are about 10% of the company's market cap. So Oaktree have got a great deal, but why you would want to be a common shareholder in this stock anymore, where you've given all the upside to Oaktree, is beyond me. So I haven't taken any profit yet in this, and I think it's got a lot further to fall. Adler has been another winner for us over the last couple of months. It's a property developer that doesn't generate any cash. It does a lot of transactions with people they know, which don't appear to benefit their existing shareholders or their debt holders. We think that the company and its related entities have too much leverage, and they'll default on that debt, and as a result, the equity will be wiped out. Grenke is another smelly company. We're currently in a dialogue with the German financial regulator on Grenke about what we think are misleading statements to equity holders about the German regulator's investigation of Grenke. Essentially, Grenke have told equity holders they've had the all clear from the regulator, but their recent bond prospectus suggests otherwise. So, we certainly think that this is a company that is at risk of losing its banking license in Germany. And if that happens, it'll have a significant risk of being able to fund its business and its assets going forward, which is not a very good business anyway. So when I tell you that their biggest business is funding photocopiers for offices, for leases, I think we could say that photocopiers are probably in a bear market, and that's probably why there's a lot of other antics going on at Grenke as well, to try to still demonstrate that it's a growth stock. And finally, Oatly. It was a toss-up between Oatly and Beyond Meat. Beyond Meat is another big short for us, and had a big profit warning last night, and it's indicating down 20%. So that should be very good for the fund, not today, but when it prices tomorrow. So Oatly, like Beyond Meat, is another, what we would say is both a fad and a fade. So oat milk and vegetarian burgers, who knows how long they'll be popular for, but I can tell you with a huge certainty there's no economic moat, that if they're popular for a long period of time, other people will come in and produce vegan burgers and oat milk. It's ridiculous that these companies, which aren't even profitable at the EBITDA level, are valued at such astronomical price to sales multiples and price to EV multiples. To give you some indication, Oatly, which has currently got a market cap of 8 billion and did have a market cap of 12 when we started shorting it, had a value of just 2 billion 6 months before IPO. So this is a classic private equity pump and dump scheme. Find something faddish, build up the growth expectations and the story, and then dump it on the market. And we think Oatly, like Beyond Meat, are going to have a big profit warning as well. So just to sum up, why buy the Argonaut Absolute Return Fund? Well, I think it's either a tail risk diversifier or a core holding. So I think, if we're right about the risks ahead, then, making money in growth equities and bonds is going to be difficult. And, we're one of the only asset classes which, if we're positioned correctly, will be able to generate positive returns. If we're wrong, then we'll continue to be a tail risk diversifier in a bull market. So, we've generated good returns over the last 3 years, even though we've been in a bull market, which frankly doesn't suit us, because in general, the short book will be a handbrake on returns. But I think, if we come to be in a more difficult market, then, you're not going to make returns from beta, and you're not going to maybe make returns from some of the active managers which have been so successful over the last few years. And therefore, I think that, we provide a pretty unique return profile, which should be blended with other funds as well. I'm not saying, put 100% in our fund, because, we're generally positioned to be a diversifier with that double-digit uncorrelated return. That's the very essence of what the fund aims to do. And therefore, you know, if you believe like me that the risks of change and we're potentially in a news cycle, then I think our strategy is a core holding. But even if you don't believe in what I say, but you know, you think there might be a risk, then we're obviously a tail risk diversifier for you. And with that, I've still left 20 minutes for questions. So hopefully we can have some questions. And then if we don't get around to your question, we can get back to you after the call and deal with it then. So Joe, back to you.
Many thanks, Barry. Very, very insightful. I'm sure we'll agree. We've got some great questions that have come in, actually, so thanks. First question, what do you see as the minimum holding period for this type of strategy? So if you're going to invest now, how long should you be holding for as a minimum for something like this?
To hold the fund, I think you've got to look at the fund as what it does for you and your overall portfolio. So, you know, I think that historically we've had two types of investor in the fund. The opportunistic investor that, if you like, you know, has seen the strong recent performance and is maybe cautious on markets and wants to hold the fund on an opportunistic basis. And then the long-term unit holder that understands that the risk return profile is different on this fund than it is for most of the other funds that they hold, and that therefore we blend well. So, you know, we've had periods where we've been their best performing fund, and we've had periods where we've been their worst performing fund. And you know, I would expect that to continue, because frankly, that's why we're valuable as a fund, because we will deliver returns at different times than everything else that you own. And if we were middle of the pack, we wouldn't be worth owning, because we would just, you know, be more of what you've got already. So, you know, frankly, you know, I think like everyone, I would like more of the latter and less of the former, but, you know, generally everybody's welcome.
Okay, brilliant. Thank you. What do you see as the biggest risk to market stability?
In terms, I just think we're moving into an era of more and more volatile macro. And I think what I'm talking about, there's going to be no one event where people wake up and go, yeah, the bull market in long duration assets is over. It's going to be drip, drip. And what I worry about, if I think about where I could be wrong, it would be that suddenly central banks really, really panic about inflation and really tighten very aggressively. And that would cause a demand shock and a deflationary bust. And that would be bad for all assets, but it would be bad for some of the longs that we hold in the commodity space. So, you know, if I saw that, obviously I would change the portfolio and you know, reduce some of our commodity beta quite quickly. But for that to happen, central banks would have to really change direction. And, you know, you would have to have a Paul Volcker in charge of the Fed. And remember, we had a decade of 70 stagflation before Volcker started tightening in 81. Okay. So I believe that central banks just aren't that brave nowadays. And the whole thing about monetary tightening has become very political. And I think, frankly, even Powell, who is quite centrist, is too scared to tighten monetary policy too quickly, because he'll get such a grilling about people losing their jobs and how unfair it is and all of this. So we're not in an era where you've got tough guy central bankers. I think things will have to get a lot worse before you've got that. And of course, there is a risk that Powell might be replaced by Lael Brainard, who's the most dovish central banker on the Fed. And if that happens, you know, rates may never go up, whatever the inflation may be. What you will get is probably a steepening of the curve. And I think one of the problems that we've had this year is that equity performance is on the style risk side, which has affected our long book, has been very dependent on the shape of the yield curve. So for the first 3 months of the year, yield curves were steepening, cyclicals did well. Then from April to September, the yield curve flattened because central banks, they thought that we're going to move too quickly and kill the cycle. And even cyclicals that were doing really well and increasing their profits did really badly on the long book for a number of months, and growth stocks did really well. I think since September, you've seen a reverse of that because people are beginning to think that, you know, inflation is more permanent and central banks are just behind the curve and going to let it run. But if I think about the biggest risk that I worry about in terms of how we're set up, it certainly is that risk.
Okay, thank you. Can you give us a summary of performance this year? I know you've had a really, really strong 8 weeks. Can you give a bit of a summary of this year's performance for the fund?
Yeah, so I mean, I guess I kind of touched on that in the last in the last comment, but I would say most people shorting this year have obviously lost money because the market is up so strongly. And shorts have been difficult. And, you know, one of the reasons for that is that, you know, the market doesn't seem to care about valuations anymore. And so you've had just, you know, you've had the meme stocks in the US, for example, you know, just ridiculous. Nobody cares about valuations. And I think, you know, that is a sign of that we're in a very mature bull market. The last time that happened to me, where retail investors outperformed professional investors, was in 1999, right? Where 12-year-olds are making 2,000% in crypto in a week. Nobody wants professional investors when it's so easy for retail investors, but that doesn't last. And when you look at, you know, half of the posters on the tube at the moment being about investing in crypto, when you look at retail participation and retail expectations of returns as well, which a survey came out this week, and the average US retail investor expects 20% annual returns. That tells you that we're somewhere close to the peak of sentiment, or sentiment is dangerously high. So I'm expecting, you know, the short book to start performing really well again, and we've had some really good successes late. So, you know, we talked about Beyond Meat, which is down 20% last night, which is a 4.5% position for us. TPEC was earlier this week is down 25%. Adler is down, you know, 50% in 2 months. You know, they are by no means the only ones. You know, I think it's not difficult to find fraudulent, overvalued companies at the moment, but you know, those things only get punished on a systematic basis with a market shakeout. And I think the long book has been, you know, obviously what we look for is cheap stocks with earnings upgrades. In general, I think what has hampered long book performance in the last couple of years is we are quite valuation sensitive. So, you know, we just don't want to be paying ridiculous multiples for stocks that are leading this bull market. And particularly when we see such good value in cyclical and commodity parts of the market. But I think, you know, what was frustrating, I think, in Q2, where the long book did quite badly this year, was that, you know, none of the stocks that did badly actually had profit warnings. In fact, the profit estimates went up and are still going up, but they went down because of the bond market yield curve flattened, and people thought that was, you know, predicting a recession and that they should get out of cyclicals. And then, you know, when we buy equities, I made a comment earlier this year where we were actually trading the bond market, and I think even a number of esteemed bond market investors have got it badly wrong this year. So, you know, I think that has been a frustration on the long book. But I think that, you know, again, I think that, you know, as people come to accept that, you know, these inflationary pressures aren't going to go away quickly, then some of these things should get higher multiples.
Okay, thank you. Next one. Do you see the breakup of big tech inevitable?
I don't think it's inevitable, but it's looking more likely. So,
right.
You know, I think that, you know, one of the things obviously to think about with tech is there are stocks that are stupidly valued, but, you know, a lot of the big tech companies aren't stupidly valued, but they're probably doing too well, and they're probably therefore going to be regulated more strictly. And people have sort of thought that the big tech companies were, if you like, a safe haven from the supply shortages. After all, you know, they don't manufacture anything, they have free inventory and just sell adverts. And I think when Snapchat had a profit warning, it said that people aren't advertising because what's the point of advertising when you've got no stock to sell? That was a good example of how this actually affects tech stocks as well, and therefore the profits of tech stocks. But I think, you know, the one thing that Democrats and Republicans seem to be able to agree on, apart from China, is just the power of big tech that needs to be regulated. And I think if we've seen that also with a lot of internet companies, just a simple change in the Apple iPhone software has caused a lot of tech companies to have profit warnings this quarter. And I think the ability of big tech companies to be able to, you know, monitor us and use the data has probably peaked. Now, I'm not short any of those big tech companies because, you know, I don't believe they don't, you know, they're not stupidly valued, they're not frauds, and it's too early to, and I also see so many other great shorting opportunities, but I'm not long them either, simply because if we are moving into a new era, then it's unlikely that the winners of the past era are going to be the same as those of the new era.
Okay, thank you. Do you have a view on the Rivian IPO yesterday?
I don't have a strong view, but I think what we have seen in a lot of these IPOs is the day one price is the peak price. And you know, there's obviously a large degree of enthusiastic retail participation in everything EV. And whilst I don't want to be disparaging about that, the difference between a retail investor and somebody that does equity analysis and valuation is that the retail investor invests in a narrative and the professional investor tries to find undervalued stocks. And none of these pure play EV stocks are undervalued. And you know, I'll give the example that I've been given for a long time now, and you know, I feel like, you know, I'm just a sort of embarrassed. It's like the embarrassing dad syndrome when you point out that to your kid that Volkswagen Group, i.e. including Porsche, Audi, Lamborghini, all of this stuff, will be producing the same number of electric cars next year as Tesla, and yet, you know, is on, you know, what, 5% of the valuation? That they don't want to know, because they love Elon Musk and they love the idea of investing in EVs and it's the future. So, you know, valuation has gone out the window, and that's frustrating from a professional investor because, you know, frankly, you know, your 14-year-old kids are outperforming you on the long side, but it doesn't last.
Yeah. Okay.
And when you've seen a few cycles before you have a degree of cynicism. Cynicism isn't necessarily well rewarded at the top of a bull market, but it is over a cycle. And I also think, you know, whereas even though I accept that decarbonisation and electric vehicles are going to happen, if you assume that 50% of electric vehicles are going to be electric by the end of the decade, then why wouldn't you just invest in commodities and power producers instead? Because what's going to happen to the power price if you have all these electric vehicles running on the grid? How much capex needs to go into the grid to upgrade it for electric vehicles? How much copper and nickel and aluminium needs to be used to make electric cars? This is where the opportunities are.
Next question. So I've got three more, Barry. This is from a client that's based in Moscow. Any thoughts on the level of the FTSE 100 and the S&P over the next 12 months? I know that's a crystal ball question, but I'd be interested to hear your thoughts. And also, do you see the ruble strengthening?
Yeah, I mean, I love the Russian market at the moment. I think if you're going to invest in any market over the next 5 years, I think Russia's going to do fantastically well. The valuations are so cheap. There's almost no stock on a double-digit PE multiple. The payout ratios are 50% at a time where it's really difficult to find yield anywhere. So that, the average Russian stock is trading on a PE of 6 with a dividend yield of 10. And if you're going to get stagflation, Russia's going to be a big winner, and it's going to be a big winner from decarbonisation as well, because essentially, if the West gives up producing oil, there's going to be Russia and Saudi Arabia still producing it. If you look at Gazprom, one of the reasons why the gas price is so high in Europe isn't that Putin is messing us around that much. It's because the Chinese want all that gas as well. China's got a power crisis. China wants to import Russian gas. And the Russians are finding themselves in a more powerful position because it's got scarce resources. There's no longer an abundance of cheap energy, and Russia's got a load of cheap energy. So, we like Sberbank as well, which, is a fantastically profitable bank with, loads of great technology as well. Again, stupid valuation for what's actually a growth stock rather than most of the banks in Western Europe. So I mean, views on FTSE and S&P. Look, I think that they're widely diversified indices, and obviously the FTSE has got more commodity exposure than many other things in Europe. So I don't think the outlook for them is terribly bad compared to maybe some other things. And I'm not calling for let's be clear, I'm not calling for a stock market crash, because I think this is going to be a drip, that we're in a stagflationary era. And when companies, there are lots of companies at the moment having profit warnings because of supply chain issues. Generally, I think the market thinks that those supply chain issues are going to go away. More structural issues in supply chains, which means they're going to last for a period of time. And when the price of one commodity, like say lumber, goes down, and the price of another commodity goes up. So it's a little bit like whack-a-mole at the moment. You whack one mole on the head and another one comes up, and you've got to whack that one on the head. And I think that's going to continue over a number of years.
Okay, thank you. Right, two more questions. COVID, are we out of the woods? Can we afford more lockdowns?
Yeah, I mean, I've stopped talking about COVID, to be honest, because, it's kind of like double embarrassing dad syndrome. I mean, when we, came out with our view on the vaccines last year, we said that they're not like polio vaccines where you take one and you're not going to get COVID. We said these are like flu vaccines. They don't stop transmission, but they probably will, particularly if you're elderly and frail, help you stop severe disease progression. And of course, we got called all sorts of things, including anti-vax and, science denier or whatever. 15 months on, we've been completely vindicated in our analysis of COVID vaccines. The problem is we didn't make any money out of it because nobody cares. The market has just gone along with the official narrative, which as long as governments think that COVID is over and the vaccine works, then the market is fine with that. So I think you've had to be in a parallel universe to really understand COVID, and it's not a rational universe. And so, look, I think one of the things that has obviously come out recently is the fact that you now can take, if you get COVID, you can now take a pill, which is probably more effective than the vaccine in stopping serious disease progression. So I think vaccines, the debate is what price will that pill be? Because if it's competitive with vaccines, you don't need vaccines anymore. And that'll mean a return to normal. And that'll mean that our thesis that we're worried about COVID because the vaccines don't work as well as what we've been led to believe isn't so strong anymore. But I could probably say or predict with quite a high degree of certainty that there'll be a lot of COVID cases this winter in the Northern Hemisphere. That particularly with boosters, there probably won't be the same number of deaths. It's sort of finger in the air as to what governments do, though, and predicting the government response, whether it's going to be rational or irrational, is really at the moment a big unknown. But, certainly at the moment, we've got no big bet either way.
Okay, thank you. And last question. What is your typical amount of stocks that you hold? How many long, how many shorts? Yeah. And are you confident of the double-digit return for 2021? Finishing out the year.
So look, I think if I mark to market the portfolio today, we're probably up 6.5% for the year so far.
Right.
Now, do I think we can get to 10% by the end of the year? Yes, I think we can. It's not certain. Look, I think that certainly Q2 wasn't as good as what I would like due to what we've talked about with the bond market. But the return has been non-correlated, and it's been certainly non-correlated to growth funds. So if you own a lot of growth funds, we did well in Q1 when those did badly, and when they had a wobble at the start of in September and October, we also did well when those did badly. So I've been pleased with when we've performed. I would like, and I'm hopeful of a higher return by the end of the year. But I think one of the things with this fund is that the returns have been we had a number of years where we had a number of very good years in a row. The returns in the last few years have been more patchy, and I think that just reflects the fact that we have a different investment process to where you want to be in this market. So if you're a guy that is basically you buy growth stocks at any price, and you maybe short a few value stocks, but you've got a big growth beta, you've done well. That's not the way we pick stocks. So I think that's been quite difficult, but I don't want to change my stock picking process after 4 years of what I see as an unsustainable boom in growth at any price stocks.
Okay, thank you. And just sorry, the one last one. Typical holding, how many stocks, how many long, how many short,
so typically
for example?
Maybe 40 longs and 30 shorts.
Net long.
So typically we'll hold 40 long positions and 30 shorts. I think we've all pretty much always been net long, because you have to think about the beta of the short book being higher than the beta of the long book. And the fact that obviously, market conditions over most of the fund launch has been pretty favorable. So, we wanted to hedge rather than bet on markets going down, and we continue to do that. So, even though we've made this call on now it's time to hedge, I think we put that out sort of 6 weeks ago or 2 months ago. The market's actually up rather than down. but we're actually up quite a lot as well. So, you know, I think it's still time to hedge. You haven't missed it.
Okay, fantastic. Well, on behalf of everyone at Acorn, Barry, thanks very much. That was really insightful. I'm sure we'll agree. Thank you to everyone who's dialed in, making the time this morning or afternoon, evening, wherever you are. These slides will be available. We will follow up over the next week or so to see if you have any other questions. And please feel free to come back to any of us at Argonaut or Acorn should you need any fact sheets or more material, etc. Once again, thanks ever so much, Barry. Really appreciate your time this morning.
Thanks, everyone.
Thank you all.
Okay, thanks. Bye-bye.
Bye-bye.